3 years ago, people were lining up to buy stocks they barely understood. 2 years ago, it was houses, bidding wars, waived inspections, price only goes up. Last year, it was AI startups with no revenue and trillion-dollar dreams. And now, it's happening again. Only this time, it's bigger and quieter. You don't see crowds, you don't see headlines screaming panic, but under the surface, the same mechanics are spinning up again, only now they're wired directly into the global financial system. Let's slow this down, because what's happening right now matters more than most people realize. Not because of hype, but because of math. Here's the setup. After 2020, the world flooded itself with money. Central banks cut interest rates to zero. Governments printed trillions to keep economies alive. Stimulus checks, emergency lending, corporate bailouts. It worked, at first. Markets bounced. Asset prices exploded. Stocks doubled. Crypto went vertical. Home prices rose 40% in some regions in less than 2 years. When money is cheap, everything looks profitable. But cheap money has a side effect. It distorts risk. When interest rates are near zero, investors stop asking, "Is this safe?" and start asking, "How fast can it grow?" That's when bubbles form. And in 2022, the music stopped. Inflation surged, central banks panicked, rates shot up at the fastest pace in 40 years. And suddenly, the same assets that looked unstoppable started cracking. Tech stocks fell 70%, crypto collapsed, regional banks failed, housing froze. That should have been the reset. That should have been the cleansing fire. Instead, something else happened. Governments stepped in again, quietly, strategically. And now we're watching a new cycle build, one powered not by consumers, but by institutions. Here's the part most people are missing. The global financial system runs on debt, not savings, not profits, debt. Governments borrow, corporations borrow, households borrow, banks lend against that borrowing, then they package it, insure it, trade it, and leverage it. The entire system assumes tomorrow will be bigger than today. Because if growth slows, debt becomes heavy. And right now, global debt is over $300 trillion. That's not a typo. 300 trillion. That's more than 3 times global GDP. Now here's where it gets uncomfortable. For a decade, that debt was manageable because interest rates were near zero. Borrow at 1%, invest at 5%, easy spread. But when rates rise to 5%, that math flips. Governments now owe trillions in interest alone. The United States is paying over $1 trillion a year just in interest on its debt. That's more than the defense budget. And that number rises every time old debt rolls over into new, higher rate debt. This isn't dramatic speculation. It's arithmetic. So what do governments do? They borrow more. They issue more bonds to cover old bonds, which works as long as someone keeps buying those bonds. Here's the twist. For decades, foreign governments bought US debt. China, Japan, oil-rich nations. They needed dollars for trade. They recycled profits back into US treasuries. But recently, foreign demand has softened. China has reduced its treasury holdings. Japan is dealing with its own currency crisis. So who's buying? Domestic institutions, banks, pension funds, insurance companies, and increasingly, the Federal Reserve itself through indirect liquidity programs. This is where the quiet escalation begins. When central banks raise rates to fight inflation, they're tightening the system. But when financial markets wobble, they inject liquidity to stabilize it. Tighten with one hand, ease with the other. It's a delicate dance, and it creates a strange paradox. Rates are, quote, high, but liquidity keeps sneaking back in. Look at 2023. Regional banks started failing. Silicon Valley Bank collapsed under the weight of long-term bonds losing value as rates rose. Instead of letting contagion spread, regulators created emergency lending facilities. Billions were injected. Balance sheets expanded again. Markets rallied. It felt like stability. But underneath, something shifted. The financial system became even more dependent on support. Now layer this on top. Artificial intelligence, energy transitions,
defense spending. Governments are committing trillions to industrial policy, semiconductor plants, green infrastructure, military expansion. These aren't small line items. They're massive debt-funded commitments, which means even more bonds, more issuance,
more dependency on buyers. At the same time, equity markets are back near record highs. A handful of mega-cap tech companies are carrying entire indices. Valuations are stretched again. And retail investors are re-entering, not cautiously, but confidently. Because the last downturn was short, because the Fed won't let it crash, because this time is different. That phrase again. It's happening again. But here's the part that makes this cycle bigger. In previous bubbles, the excess was concentrated. Dot-com stocks, subprime mortgages, crypto. Today, the excess is systemic. It's embedded in sovereign debt, in pension obligations, in commercial real estate loans that were refinanced at low rates and now face resets at double the cost. Office buildings in major cities are worth less than the debt tied to them. Banks are sitting on unrealized losses in long-term bonds. Governments are running deficits near recession levels during economic expansion. That's unusual. Historically, deficits shrink when economies grow. Now they don't. Why? Because structural spending is locked in. Entitlements, healthcare, interest. The machine must keep running. And the only way to keep it running without immediate pain is liquidity. Liquidity is the oxygen of markets. Remove it, and prices fall. Inject it, and assets rise. Right now, we're in a strange middle ground. Inflation hasn't fully disappeared. Growth is slowing but not collapsing. Markets are optimistic. Bond markets are uneasy. The yield curve has been inverted for over a year. Historically, one of the most reliable recession indicators. Long-term rates higher than short-term growth expectations. That's the bond market whispering, something's off. Yet equities ignore it. Why? Because liquidity hasn't fully dried up. Because earnings from a few dominant firms mask weakness elsewhere. Because passive investing funnels money into the same names regardless of valuation. And because people have been conditioned to buy every dip. Here's the uncomfortable math. If debt keeps growing faster than GDP, interest costs compound. If interest costs rise faster than tax revenues, deficits widen. If deficits widen, more bonds are issued. If bond supply rises faster than demand, yields must increase to attract buyers. Higher yields mean higher borrowing costs, which increases deficits further. It's a feedback loop. The system can manage it until it can't. And the breaking point doesn't announce itself. It starts with stress somewhere contained. A bank, a currency, a funding market. Then confidence shifts. And confidence is the invisible glue holding leveraged systems together. We saw a glimpse in 2020, another in 2023. Each time, intervention came fast enough. But each intervention adds more debt, more complexity, more fragility. Here's the irony. The policies designed to prevent collapse can slowly increase long-term risk. Stability becomes addictive. Markets price and rescue as a certainty. Risk premiums compress. Leverage builds quietly. Then one day the rescue becomes harder. Because inflation limits money printing. Because political will fractures. Because foreign buyers step back. And that's when bigger becomes visible. Not louder, just wider. A slowdown that governments can't easily stimulate without reigniting inflation. A bond market demanding higher compensation. A currency under pressure. And asset prices that were priced for perfection, adjusting to reality. None of this guarantees catastrophe. It guarantees tension. A system stretched between high debt and high rates. Between optimism and arithmetic. The cycle isn't identical to 2008. It isn't 2000. It's structurally different. Back then, private sector excess dominated. Today, public balance sheets carry the weight. And governments don't go bankrupt easily. They inflate. They tax.
They restructure quietly. Which means the risk isn't necessarily a dramatic crash. It could be something slower. persistent inflation that erodes purchasing power. Financial repression, where savings earn less than inflation. Asset volatility that whipsaws confidence. In other words, a long squeeze rather than a single explosion. But make no mistake, the leverage is larger. The debt is larger. The interconnections are deeper. That's why this time is bigger. Not because headlines are louder, but because the foundation itself is carrying more weight than ever before. The question isn't whether cycles repeat. They always do. The question is what breaks first when a system built on expanding debt meets the limits of growth. Will it be a bond market revolt? A currency shift? A wave of defaults in commercial real estate? Or will policymakers manage another controlled burn, extending the cycle yet again? Right now, markets are betting on control, on intervention, on resilience. Maybe they're right. But when a system depends on confidence, and confidence depends on ever-rising debt being manageable, the margin for error gets thinner each year. It's happening again. The build-up. The quiet leverage. The belief that support will always arrive. And maybe it will. Until the day it doesn't. When that day comes, it won't start with panic. It will start with a small crack in something most people weren't watching. The only question is, where is that crack forming right now?